Greetings everyone. Welcome to my channel Inside Accountancy by Shakun, Accounting Made Easy. First of all, thank you to all my lovely subscribers for subscribing, liking and commenting on my videos. I would also request those who are new to my channel to kindly subscribe to it, like the videos and share it as much as possible. In this video, we'll be talking about Bills of Exchange, which is chapter 16 from T.S. Gariwal. The table of contents of the video would be the meaning and features of bills of exchange and promissory note, the types and advantages of bills of exchange, and the difference between bills of exchange and a promissory note. So let's first talk about the meaning of bill of exchange. A bill of exchange is an instrument in writing containing an unconditional order signed by the maker directing a person to pay a certain sum of money only to or to the order of a certain person or to the bearer of the instrument. This is the definition which is given by Section 5 of the Negotiable Instruments Act 1881. So bills of exchange, it is an instrument. It is an instrument in writing. It is a legal document which contains an unconditional order. Unconditional order means order to make payment, which is signed by whom? By the person who is making it. And this order directs a particular person to pay a particular amount of money, sum of money, either to the person who has made it or to the order of, means any person to whom he orders the payment should be made, or to the bearer of the instrument, the person who is carrying the instrument. Let us understand the meaning of bills of exchange in detail with the help of an example. This will be a story which I will explain to you. I hope from this it will be clear what exactly bills of exchange it is. Okay, so let's assume there are two people, two persons, A and B. Now A has sold goods worth rupees 1000 to B, and B has promised to make the payment after 3 months. Now, if we look at A from B's perspective and we look at B from A's perspective, we can find out that A is the creditor in the eyes of B. Why? Because B has to make a payment of 1000 rupees to A. So A is the creditor for B. And B is a debtor for A. Why? Because A has to receive 1000 rupees from B. So A is the creditor for B and B is the debtor for A. Now B promises to make the payment after a period of 3 months. But in business, should we have trust on the verbal promises that are made by the other parties? No. There must be some documentary evidence. So what A does is he drafts a document. That is just a document. I am not giving any name to it. So A drafts a document and he sends it to B for acceptance. When B accepts it means when he puts his signature on that, his stamp of the company on that, then that document is returned back to A. And when B has given the acceptance, this document which was drafted by A sent to B for acceptance, this document is called as a bill of exchange. Okay, so a bill of exchange is a document which has been drafted by the creditor, the person who is selling the goods, and it is an order to make the payment. Who is A directing to make the payment to? A is directing B to make a payment of 1000 rupees after 3 months. Right now, this bills of exchange, the person who is drafting it is known as the drawer. The person who is making the bill of exchange is known as the drawer. And the person on whom the bill of exchange is made is known as the drawee. So the person who is the seller, the creditor, he is known as the drawer because he drafts the document. And the person who is purchasing the goods, the person who is the debtor, is known as the drawee because he is the person who is supposed to make the payment. It means that bills of exchange is drawn by a person directing another person to pay the specified sum of money to whom? To the bearer of the instrument or to a specified person, which may be him or anyone to his order. The person so directed or ordered must accept it so that it becomes a bill of exchange. So therefore, this is the meaning of bills of exchange. I hope that is clear. So the person drafting it is known as drawer and the person accepting it is known as the drawee. Now let's talk about the features of bills of exchange on the basis of the definition that we just studied. So first feature is that a bill of exchange is a written order. It is a legal document. It is made by the drawer, the person who is selling the goods, and it is an order made to the person who is purchasing the good or the person who has to make the payment. So it is a written order. Second feature is it is drawn and it is signed by the maker, that is the drawer of the bill. Maker of the bill, maker of the document is known as the drawer. So it is drawn by the maker or the drawer and it must also be signed by him. A bill of exchange is an unconditional order to a person. Who's that person? The person who has to pay the money. That is the drawee. So it is an unconditional order to the drawee to make the payment of a specified amount. The specified amount is payable to the person named in the bill or to his order or to the bearer. So the person who is making the bill, that is the drawer, either he will receive the payment or any person carrying the bill of exchange will receive the payment or any person to whom the drawer has ordered may receive the payment. Next is it specifies the date of maturity or the due date. That is the date by which the amount should be paid. Like in the example we had taken 3 months. So the bill was drawn at 3 months. After 3 months the payment should be made to the drawer, the maker of the bill. It is accepted by the drawee to make it a legal document. See, when I gave you an example, I told you A or the seller or the creditor, he drafts a document. I did not name the document till then. Why? Because until and unless the drawee accepts it, until and unless the drawee puts his signature or his stamp on that document, until that time the document is not a legal document. So once accepted by the drawee, it becomes a legal document which can be used as a documentary evidence in the court of law. Moving on, what are the parties to a bill of exchange? See, I've already explained two to you. So when we talk about the parties to a bill of exchange, there are three parties: the drawer, the drawee, and the payee. Drawer, I've already explained, is a person who makes or who writes the bill of exchange. Like in our example, A was the drawer. Drawee is the person on whom the bill of exchange is drawn. That is the person who has to make the payment, who has accepted the bill. Like in our example, B was the drawee. And who is the payee? Now, payee is a person to whom the payment is to be made. In the definition only, we understood it. We read that the payment can either be made to a specified person or it may be made to the drawer or it may be made to the bearer of the instrument. Okay, so whoever receives the payment will be known as the payee. So drawer is the person making the bill of exchange, drawee is the person who has to make the payment on whom the bill is drawn, and payee is the person to whom the payment is to be made, the person who receives the payment against the bill of exchange. Now let's talk about the types of bill of exchange. There are basically two types of bills of exchange: trade bills and accommodation bills. Commonly what we know as trade bills. Trade bills is that kind of a bill of exchange which is drawn and accepted for a trade transaction. Trade transaction in terms of sales or purchase. Like in our example, A sold goods to B and because of that the bill was drawn. That is known as a trade bill. Now, what are accommodation bills? Accommodation bills is a bill of exchange which is drawn and accepted for mutual help. This is not in your syllabus, but I'll still explain a little bit of it. Let's say A and B are two friends. A is in need of funds. A has not sold any goods to B, but A is in need of funds. So what A does is he draws a bill of exchange on B. So you must be wondering that if A is in need of funds, how is this bill of exchange going to help him? Because this bill of exchange can be sent by A to his bank, and the money can be received from the bank. Later on the date of maturity, B can make the payment to the bank. So if A draws a bill for 3 months on B and gets it discounted with the bank, so A, suppose the bill was 1000 rupees. So what happens is A gives the bill to the bank and receives 990 rupees from the bank. So A was in need of funds, he got the funds. Now after 3 months, after the period of 3 months, B is going to make the payment to the bank. These are known as accommodation bills, which are accepted, drawn for mutual help. Now let us talk about the advantages of bills of exchange. So there are 7 advantages of bills of exchange. We'll be talking about each one in detail. The first one is facilitates purchase and sale of goods on credit. So it helps us in the credit purchase and sale of goods. Why? Because bills of exchange is an unconditional promise to pay. So because of bills of exchange, there is a surety that the amount will be received since it is a legal document. Second one is serves as a source of finance. Now bills of exchange is a source of finance. How? Because this bill can be discounted with the bank, and the enterprise allowing credit can receive the amount immediately from the bank without the debtor having to pay before time. So what the thing that I just explained to you as in case of A and B. So let's say A and B is the drawer. So B has the bills of exchange. A has the bills of exchange. So what happens is A has the bills of exchange and can give this to the bank and get the required funds which are required. So that is why we say serves as a source of finance, because the amount of the bill 1000 rupees, let's say, if payable after 3 months, A can get the amount from the bank before the date of maturity. On the date of maturity, B can make the payment to whom? To the bank. Moving on, the next advantage is easy to recover the amount. Now, why is it easy? Because if a bill of exchange is dishonored, means it is cancelled because of any reason, maybe the drawee refused to make the payment or the check bounced. So if a bill of exchange is dishonored, it is easier to recover the amount legally than in case of any ordinary debt. Since it's just not a promise, it is a legal document, so it is easy to recover the amount because it serves as a documentary evidence in the court of law. Next is endorsement. So a bill of exchange can be endorsed to other parties also. Thus it serves almost the same purpose as cash. So what happens is, I'll just take another example here. So we had two people here, A and B, and A was the drawer and he had the bill of exchange which was drawn on B. The amount of goods was 1000, payable after 3 months. Now what happens is, A has the bills of exchange. A had to make a payment of 1000 to C, who was A's creditor. So A had to receive 1000 rupees from B and had to pay 1000 rupees to C. So what A can do is, A can give this bills of exchange to C. Instead of giving him cash, A can pass on the bills of exchange to C and tell him after 3 months you will receive the payment. So after 3 months, B is going to make the payment to whom? To whom A has ordered, the person having the bill of exchange, that is C. So this is known as endorsement. एक का bill दूसरे को दे दिया. A had to receive 1000 from B, had to pay 1000 to C. So what he did, instead of giving cash, he passed on the bills of exchange to C. This is known as endorsement. The next advantage is certainty as to payment. Now the date of payment is certain here. The enterprise which has to pay and that which has to receive the amount can thus plan the cash management accordingly, because the due date, the date of maturity is fixed. So both the parties, they know when the payment is to be made or when the payment is to be received, so they can plan their cash accordingly. Convenient means of trade remittance. So it is a very convenient means of making and receiving payments as the amount is transacted through bank. Next is valid evidence of debt. Now, since bill of exchange is a written acknowledgement, it is a written order, it is an acknowledgement of debt and it is signed and stamped by both the parties. So therefore, it is a legal document and it serves as a documentary evidence in the court of law. So these were the advantages of bills of exchange. Now let us talk about the meaning of promissory note. Now, a promissory note is an instrument in writing, not being a banknote or a currency note, containing an unconditional undertaking signed by the maker to pay a certain sum of money only to or to the order of a certain person or to the bearer of instrument. Now, the definition is looking similar to the bills of exchange definition, but this definition is given under section 4, and it is an instrument in writing. It's not a banknote or a currency note, and it is an unconditional, not an order, but it is an unconditional undertaking. Okay, like we took an example of A and B. A drafts the document and sends it to B, right? This document was known as bills of exchange. But if B drafts a document and sends it to A, he is promising to make the payment. So this promising to make the payment, the document which is draft for that, is known as a promissory note. So a bills of exchange is drawn by the drawer. Drawer is the maker of the bills of exchange. But a promissory note is drawn by the person who is the drawee. The drawee is the maker of the promissory note. Okay. So the drawer makes the bills of exchange, but the drawee makes the promissory note. Now, what are the features? Okay, so the first feature is promissory note is an unconditional written undertaking, and it is an undertaking to pay the specified amount to the person on whom the promissory note has been made. It is drawn and signed by the maker. Now, who is the maker here? The person who is promising. Like in our example, if B is the drawee and he promises to make the payment, then B is the maker, he is the promiser, and he is the maker of the promissory note. Next is it specifies the name of the payee to whom the payment is to be made, and it also specifies the date of payment. Specified amount is payable to the specified person or to his order or to the bearer. Again, that condition holds true, that the amount will be paid either on the person to whom the promissory note is given, or anyone to his order, or to the bearer of that instrument. So these were the features of promissory note. Now, in a promissory note, there are two parties. Unlike bills of exchange, where we had three parties: the drawer, the drawee, and the payee. Here we have two parties: the maker and the payee. Maker is the person who is making the promise, who has availed the credit, and payee is the person to whom the payment is to be made. Now, in this situation, in case of a promissory note, who is going to be the payee? Who is going to receive the payment? That is A, or any person to his order. Now, let's talk about the difference between bills of exchange and promissory note. Okay, so these are some points of difference between bills of exchange and promissory note. First is in terms of drawer. Okay, the creditor is the drawer. In case of bills of exchange, creditor, like in our example, A was the creditor, the person who was selling the goods, the seller. He is known as the drawer. But in case of a promissory note, debtor is the drawer. Debtor. Who was a debtor? B was a debtor in our situation. Order or promise. Now, bills of exchange is an order to pay, because A is drawing the bills of exchange. He is ordering B to make the payment. But on the other hand, promissory note is a promise made by the debtor, that is B, that he is going to make the payment. Acceptance, we have talked about too. Acceptance. It needs acceptance by the drawee, because it is drawn by the drawer on the drawee. So the acceptance of the drawee is very, very important, and without that it does not become a legal document. But in case of promissory note, acceptance is not required, because it is a promise which is made by the person who has to make the payment, that is B, right? The maker of the promissory note. Parties, there are three parties: drawer, drawee, and payee. But in case of promissory note, only two: maker, who is the promisor, and as well as the payee. In terms of liability, the liability of the drawer arises only if the acceptor does not pay. So the drawer is not liable to make any payment until and unless the acceptor or the debtor or the drawee refuses to make the payment. But in case of promissory note, promisor has the primary liability to make the payment to the drawer. Do not get confused between drawer and drawee, please. Copies. So only one copy of bills of exchange is required, but in case of foreign bills, 3 copies are required. But in case of the promissory note, always, even in case of foreign bills, only 1 copy is required. Now talking about the stamps, stamps are necessary except in case of bills payable on demand. In case of bills payable on demand, stamps are not necessary. But in case of a promissory note, it should always be stamped. So in this video, we've talked about a lot of things about the meaning of bills of exchange, about the meaning of promissory note, their features, parties, etc. Thank you so much for listening to me so intently. In case you liked my video, please show some love and hit the like button. If you have any questions, contact me on my email ID or you can leave comments below. Subscribe, like, share. Do not forget. This is Inside Accountancy by Shakun signing off. Thank you.